a horror show session where the Dow tumbled 1,679 points. S&P plunged 4.84%, and the Nasdaq plummeted 5.97%.
When President Donald Trump launched a trade war and imposed drastic tariffs, the markets literally collapsed. U.S. equities were heavily in the red, and the likes of the Nasdaq, which is now down 21.6% since the peak, has officially entered a bear market for the first time since 2022, gaining over 106%. Not only does this present a challenge for seasoned investors, but more importantly, it presents opportunities for retail investors who have never experienced such volatility before. Indeed, it is also currently at 2022 levels. Although the current stock market chaos may seem like the end of the investment world, it is essential to keep a cool head. The best days in the market often come during big downturns, and if you miss them, you could miss out on huge gains. Fortunately, there is one indicator that can help us identify the bottom. The markets have been in a free fall in response to President Donald Trump's far-reaching tariffs. All major U.S. indices are in the red and look headed for bearish territory behind the Nasdaq. After a long period of growth that has lasted in the market since the end of 2022, this could be scary for investors who are not used to such turmoil. But history tells us that these dips are the biggest opportunities. Let's look at it this way. Most of the stock market's gains each year are made in a matter of days. This means that if you get out of stocks and try to time the market, you are very likely to miss the bounce. In fact, when markets fall as fast as we have seen in recent days, there is usually a so-called short covering rally that drives the price up, often significantly and in a short period of time. Why? It's actually quite simple. When the market is falling fast, many investors enter short positions. But as soon as the market makes any move against those positions, investors start losing money and selling shorts, thus amplifying the move up. Then the price can continue down. For example, in the 2022 downturn, the S&P 500 index returned as much as 17% at one point, and it still did not mark a trend reversal. The price then ended even significantly lower. But once the bottom comes in, the reversal can be quick. What happens all the time, though, is the number of subscribers to our channel. So join in too so you don't miss any videos with top information from the world of stocks. So if you try to time the market, you could hurt your future returns. In fact, according to an analysis of market performance over the last 100 years, 78% of the best stock market days occurred during a bear market, or the first 2 months of a bull market. If you missed the 10 best days of the market over the past 30 years, your returns would be cut in half. In practice, this means that if the S&P 500 index has risen 942% since 1995, and you missed those best days, your return would be less than 500%. And if you missed the best 30 days, it would reduce your returns by a whopping 83%. So what can we expect from the markets? Volatility hit its highest levels since the summer last week, when it shot up only very quickly in the aftermath of the monetary policy change in Japan. But the markets quickly stabilized and continued to rise. The VIX was still at these levels in 2020, when markets sold off due to fears of a COVID pandemic. Back then, volatility levels were even higher. And that's interesting because here we have 2 cases from recent years where the bottom in the market came when volatility was at even higher levels than it is now. But on the other hand, it's a different situation, which is mainly fueled by the trade war that Donald Trump has unleashed. Many things are not yet clear. For example, how Europe and the rest of the world will react to the tariffs, apart from China, which has already announced retaliatory tariffs. Once that happens, all 𝗕𝗂𝗶адц Black members will know in no time thanks to Flash News, which covers stock market news from around the world. In addition, the Fair Price Index now includes some very interesting companies that are trading, according to DCF and relative valuations, well below their fair price, thanks to the declines of the past few days. In the stock detail, you will then find all the additional information you need for analysis, so check it out and pick stocks like a pro. The chart now shows the most important support value on the S&P 500 index at 4,800 points. This is where the market turned around and started to fall in 2022. So far, it looks like price is respecting that zone. But if there is a move lower, it could mean further declines. But even if that happens, all days are not over. I'm sure you're familiar with Vanguard. So during these downturns, it sent out an email to clients urging them to stay invested. In the email, it said, "In uncertain times, resist the urge to deviate from your financial plan. While we can't predict when volatility will subside, history shows that markets will eventually bounce back from a bottom. This is important to come to terms with. Nothing and no one, not Warren Buffett or Trump, can predict what the market will do and when it will hit bottom. But it is important to be prepared. But there is one more statistic we need to know, and that is the valuation of the stock market compared to the biggest companies. The S&P 500 is now more exposed to the largest companies than ever before, and they now make up 40% of its weight. That's not necessarily a bad thing. They are good companies. But the problem is that their valuations are too high, and they are moving away from the overall index average. Their movements thus contribute significantly to the movement of the overall index, and are thus responsible for these rapid and large declines. Investors could thus be in for a prolonged period of pain, especially if Trump's trade war continues and the United States falls into recession, as many analysts are now predicting. But it is not just the US market that is falling. The European one opened today with a 9.5% gap down. It still beats its US counterparts in 2025, but even the DAX is already in the red this year. The price has fallen 17% since the peak. And if that still doesn't sound like much to you, let's look at Asia. Hong Kong's Hang Seng Index opened the week today with a massive 13% loss. So there are opportunities everywhere, and in the years to come, diversification not just between sectors but between entire markets will be more important than ever. There is a new video coming out on Wednesday with a guide on how to benefit from the current market declines, so subscribe and ring the bell so you don't miss out. Are you making the most of the current situation, or would you still rather wait and not get burned? Let's discuss this in the comments or directly on 𝗕𝗂𝗶𝗀𝗎. Good luck with your investments.